All right, and welcome back for another episode of Carnivore Trades. Happy Memorial Day. Doing a little special video here while we have off. So I'm doing this video on Friday, May 24th. Should air on Monday. I hope everybody's enjoying their holiday weekend and a little bit of time off from the markets here, but getting a video out for you guys. This video I've been thinking about doing for a while now, and finally got around to it, but I want to talk about trend lines. So specifically, just some rules that I use, and a few guidelines. Now, trend lines are very interesting because it's definitely one area of the market where it's more art than science, right? So, everybody's, I see charts, I follow a lot of guys, and everybody has their own kind of rules and criteria for drawing them. Like, it's not like a fib, right? Where, and even if you hate fibs, I know traders who I respect that hate fibs. They never use them. They think they're nonsense. I love fibs, as you guys know, and there's plenty of traders who love fibs. But you're not gonna, if I take a fib from here to here, there's no arguing, right? Like, you can't be like, well, that's the 236, that's the 382, right? There's no discourse. It's just math, right? Whereas with the trend line, there's a lot of different things you can do, right? Like, where do you start it? Where does it end? Which is the first pivot? So on and so forth. So I want to clear that up at least. And again, this ain't the be all and all. These are just my techniques, my rules, and a few tips as well that I'll throw in there that I use. So first rule here is you have to establish major versus minor first. So most of you, this is pretty easy. If you're a little bit newer, it's important to understand those. So for instance, let's just take the spiders here, and we'll just use the correction here from late last year. If you're looking to draw a trend line on this chart from top to bottom, and again, this isn't, I'm just making just for reference, right? This is pretend that this matters. What do you think would be the most major pivot here on this chart? Right, so we go back. It's obviously this. I hope everybody knows, right? So you wouldn't start your trend line here, or doesn't mean you can't, doesn't mean it couldn't connect. But the very first thing I would look to do on a chart, if this chart was completely naked and I needed to draw a trend line, I would look to that pivot first, right? That's the most highest point on the chart, right? So if we go back to some more evidence here, highest point on the chart, we can go back even farther, going back to 2022. So, over a year, right? So that's where your big, master level is. It doesn't mean that there can't be trend lines at those other pivots, but that's the master trend line. Similarly, we're going to use, obviously, this low. There's not really another low to use in this case because we never corrected. But this would be, if we were to start here, or if we were to start looking for a trend line in this area, this is where we would start. Doesn't mean it has to happen there. There could be another trend line, at another pivot that works. But this is where I would look to start it. If there's nothing there, then you move to the next area, right? So that is like the most important thing. It's very simple, it's very basic, but that's the most important thing to establish. So you want to do it at a point where the market is telling you there's a major pivot here, right? So, I wouldn't look to do it here, right? Technically it's a pivot, right? We went down and then we went up, right? I would look to do it there, right? So major versus minor, that's the most important thing to establish. The second thing that I see most people argue about, or maybe not argue about, but kind of divided on, is where to draw the trend line in terms of wick versus body in the candle. I always go in the wick first. So what I mean by that is, we'll talk about that in a little bit, but the reason I use the wick as opposed to, like, for instance, again, just to go back to here, we'd started at the low instead of starting it right there. Why? Because price traded there, right? So if you were short, right, from here, and you covered at the low of the day, 409.21, it doesn't make the gains any less real if it closes at 410, right? Still traded there. There was still money that exchanged hands there. So I always go to the wick first. However, if the market dictates it, I will use the body. What do I mean by that? What does it mean, the market dictating? This is the biggest rule that I'm going to kind of dive into here. obviously other than major, minor, but the market dictates everything. So if there's a trend line you have drawn here, right, and the market dictates that I need to move it, I will, and I'll explain that right here. All right, so we'll just roll the clock back a bit here. And so there's two examples here. Where would we draw this? Well, I usually would start it here at the wick, right? Right there, through that. But what happened here? It didn't get there, right? So what would you do? You could just draw it through here, through the body, and technically you'd have that lined up. That's one way you could do it, or you can erase that and just redraw it like this. Right, so originally you're going wick to wick, right? That's where the market traded. But now that we've seen this pivot, we know, okay, this is where the market is respecting. It doesn't have to go through perfectly. It doesn't have to go to the penny, to the wick. It can go through the body. It can go through wherever it wants to, but you wait for the market to tell you. Now, again, would you have missed the boat if this came down, or if you were looking to buy here? Yeah, you would have missed the boat, right? You definitely would. And again, there's nothing perfect in the market, right? But in the future, you know that that's the line to look at. This actually ended up breaking down. We'll talk about why that happened later when we get to looking for how the market breaks, looking for what could indicate that it is going to break down. But just an example there, again, take it at face value. Just throwing it out there doesn't have to be perfect, but you get the idea of why we adjust that trend line there, why the market is respecting it. Another example is, and I think I have it drawn on the SPX. Yep, there we go. So the COVID trend line, right? COVID lows, and you can see that clearly. I got all my lines on there. Let me just get rid of this though, so we can see it. So again, going to the wicks, you know, if you waited to buy, you missed the boat. But why don't we just go there, right? Why is that? The more hits a level has, or an area or a trend line has, that's that's telling you that's where the market is respecting, right? So don't be locked into like, oh, it's got to be at the wick, or it's got to be at the body, or here's the trend line I drew and it can't be wrong. Like, you can adjust it. There's nothing wrong with adjusting. Like, as traders, we're wrong all the time, right? It's adapting to the market. You have to be able to flip flop, right? You know, we don't like it when politicians flip flop, but as a trader, you need to be able to flip flop. So that's an example. Another one that I think is probably the best one I can show here. There's another one too, but I'm looking at oil here, and this is a recent example. A lot of traders here, and I saw, on the internet, this is where my trend line is, but a lot of traders had this trend line drawn like this. And a lot of traders went short oil right there. Yeah, you got $3 out of it, but then it ended up, if you didn't cover, you got ripped off, pretty good. Maybe if you had held through it, you could have gotten paid, but point is, you likely would have gotten stopped out there. Why did I have my trend line drawn lower, and why was I still bullish oil through that? More hits. 1, 2, 3, 4. It's a pierce. Down 5, 6. Right? Versus this other trend line, you only have 3, and the trend lines are not very symmetrical. And plus, not only that, actually, whoops, you're literally ignoring, kind of goes through it, I guess. But I had seen some guys that had this drawn even higher. Hold on, like right to that wick, and you had it a little bit higher up, but it went right through that line there. So another thing too, like, don't ignore pivots, right? So my trend line here goes through all these, and that kept me bullish on oil through that area. Now, again, it ended up rolling over afterward, but the point is, if you're going off the trend line, you likely got stopped out there. So again, just let the market tell you. If it's hitting this area more times than it's hitting the other line, move your line, change the line, and respect that one. Another one here, Alibaba. So if we just take a look at this trend line and zoom in, this is how I originally had it drawn in. And you can see 1, 2, then it kind of just breaks through that, right? Why does it break through it so easily? Well, what if we can alter this? Yeah, technically that's a pierce, but then it hits 2 more times, and you would have noticed that right here. And then coming down, you could have been able to buy it here, and you got a 10-point pop out of it. Right, so don't let that trend line just sit there. You always like look at that, look at what the market's doing. The market's changing every day. You know, look at patterns, look at price. And by the way, this became a nice head and shoulders there perfectly. I love it when I see that stuff. I mean, this was a trend line going back to the October, and it ended up, I mean, this is why charts are so cool. It ended up turning into a head and shoulders. So, but anyway, let the market tell you, and don't be afraid to move your trend lines. Again, this is the most important rule other than learning major and minor. So again, don't be afraid to move your stuff. Anyway, side note, this also works for horizontal support and resistance, right? So if there's a level right here and it hits once, but there's a level just above it, and that hits 6 times, that's probably the level. So just a side note there. A couple other things, other rules, 3-hit rule. So generally, well, obviously you don't know that there's a trend line unless you have at least 2 pivots, because you need to be able to connect them. But generally, we can use this as a perfect example. Generally, the 3rd hit is buyable or shortable, depending if it's on the other side. And again, a perfect example right here. So again, if we move this line, we had it at the original spot, and we tried to buy the first hit, we would have lost out. But if we move it, you know that 3rd hit is going to hold. Why is that? Markets love 3s. Humans love 3s. 3 is usually going to hold on that for that trend line. It doesn't always have to. It usually will, though. Another good example. It's a short-term example here. All right. Well, you know, let's use a different one here, because that one's a little complex. We'll get into that one last. So I'm sure everybody remembers the moat, or the mother of all trend lines. So 2022 high, just connect them. 1, 2, 3. If you shorted there, which we did in Carnivore trades, actually, well, we shorted a little early. We got in a little early here, but we got there in the end. It was a very nice trade to the downside. 450 to 350, or excuse me, 430 to 350. You know, just an 80-point drop in the spiders, almost 20% there. So big move. 1, 2, 3. The 3rd one is usually very good to short. Another thing about the 3rd trend line is it is very often it wasn't really this time, but it's very often a pierce. So a lot of the time you'll hit 1, 2, 3, and then it'll kind of wick through. In fact, I think that's what it's coming back to me now. We got short in this area, and I said if we can inch up a little bit more, I would look to, you know, right maybe into this area. I'd look to add, but we never got there. Why this happens? Why does it pierce often? It's got to get people on board, right? People think it's a breakout, and then you get them stopped out, or you get the short stopped out, and then you take it down. But another example here, a couple here. Again, these are I'm just throwing these out here. Apple. Big pivot low. Again, master pivot, right? It's a major pivot. I'm not drawing it from here, right? Big major pivot after a bear market year. 2, and then 3 right here. It's definitely buyable. You know, 179 to 191 on Apple's a pretty good move. And the 4th time fails. And you can even see right here, it's almost kind of respecting that trend line in a sense right now. Not quite there, but you know, maybe it gets there next week. But 3rd hit's usually good. AMD here is another example. 1, 2, and 3. So 100 to 111, 11% move. And then perfect. Back test, right down. So theoretically, you could have played this from both sides, long, and then flip short right there. So again, it doesn't always work like that, but it usually does. So third hit, and the third hit's usually a pierce. In fact, he actually did pierce it a little bit, not by a ton. Here's the messy example I was going to talk about earlier. It is messy, takes a little bit more experience to see this and understand other factors that are going on, but this is what the market will do. It will try to, before it makes a move, bull or bear, it will try to take as many people out before it makes that move. So they will trap as many people as possible. Here's the ES. Actually, I'm going to use the SPX, but here's another example anyway. Going back to the wicks. It doesn't really work, does it? It kind of did. You kind of get a bounce off it. So I suppose it did, but you could also take it right here. Third hit worked, fourth hit failed. But what I was going to go back to here, because the S is way too messy. SPX. You guys know I was banging my fist on the table by the market down here, and we did. And 1, 2. I know it's messy, but that's a pierce, gap down, island, reversal, FOMC. They took it all the way down. Did we close below the lows? Nope. Tested it again the next morning, and then gap and go, baby. Higher lows. Even without the trend line, you got the higher lows there. So they will often try to trap as many people as possible. In fact, they will every time. They will try to trap as many people as possible before they make a move. And same thing kind of on the upside, right? You know, going back to the 2022 highs here. Big move up, up, up. New all-time high. Stop everybody out right there. And then down. So a couple of rules there. So third hit, the chances of it breaking go up a lot more. Or excuse me, after the third hit, the chances of breaking go up a lot more. Does it have to? No. You can go back here, look at the cues. 1, 2, 3, 4. I would call that a cluster. So you could call that, some people would say, oh, that's 4 or 5. I'd say that's 1. And then 6. It took 7 to hit and break down. So it doesn't have to, but the chances go up. All right, so that brings me to my next point here. So how do we know if it is going to break down, right? After the third hit, how do we, well, we never know, but what can tell us that the probabilities are increasing? Two things, well, there's multiple, of course, but one of the things I really look for is since the previous trend line hit, right? Have we made a higher high and a higher low? So I'm using nat gas here as an example. Definitely a major pivot. The lows going back to like the early 90s. You could call that a hit, doesn't really matter. Hit, high, hit, higher high, another hit, big consolidation pattern, another higher high, higher low, big higher high, another higher high, higher low. Uh-oh, watch out. Lower high after coming down to hit it again. Lost momentum. That's an indication it's ready to break down. Now, again, you can make a case, well, I just had a lower high here. Well, yeah, it still had higher lows, though. So definitely look for those when you have those higher highs since the last pivot. And not to mention, I mean, look at the consolidation pattern here. So it's not the be-all, end-all, nothing is. But every other example here, you have those big higher highs, right? Here we never even got to the trend line, but big move, higher high. So this one worked. You wouldn't know that it was going to go back to the trend line here yet, but once it started to get there, you know, maybe you look for a quick bounce and then you get out. All right, what else we got here? Let's use Tesla again. Start it here. Again, not the most ridiculously major pivot, but it's one that's recent to this time period. Higher high, higher lows, higher lows, higher lows. Melts up. Higher high, new all-time high. Higher low. higher low. Never really, actually, it never really got there. Lower high. So when you come down here again, be careful. And it ended up going higher eventually, but again, this was a really strong time in the market. But again, you get the idea, right? So look for those setups where you have the higher high in place. I think even those ones that we used earlier, yeah, AMD here, higher high, higher low, higher high, hit it again third time, definitely a lower high. Apple, same one, all-time high, slight new all-time high, then hit it, definitely a lower high. Right, so look for those little clues that can tell you the market's starting to lose momentum. The same thing on the downside. I just didn't find any examples when I was throwing this together here, but look for that. Again, it's not it's not the be all end all. It can defy that setup like I showed you on the Qs. We can go back to that even. And so right here, like we had high, we hit this, started it, we went up, hit it, we made a new high, went down, lower high, kind of hit it. Technically, I guess that was a higher high, not the best one. And then you kind of, had the double hit there. So it doesn't have to be, it doesn't have to happen. But again, those are clues, right? So we stack all the odds together, you stack all the factors up, and then you get your, we're odds makers at the end of the day, right? So we're stacking those factors up. Another thing you can look for, a couple of little extras is it a, well, here, this too, like, is it a triangular pattern, right? So if you have price inside of this, well, yeah, it's not going to make higher highs, right? It's because it's in a wedge. So that would be obviously an exception. And then that would depend on the chart. If we're going up, then it could be a bull symmetrical wedge. If we're down, it could be a bear wedge, obviously. But other things you could look at is RSI. Do you have and that could just be for a divergence, right? So if there's let's use this, because I know I was using this a few weeks ago. So there's our trend line, fake out, and you're coming off of a bullish divergence in the RSI. So likely gonna, hold up. We're oversold. Again, I just threw that example together. I'm hoping you get the idea. Another thing too could be if the RSI is confirming, a bear trend towards that trend line. Look for stuff like that. Look for momentum. Look for patterns too. If we come down, let's say here's our trend line. We hit it, and then we come down and we bear flag. Is that trend line going to be major? No, it's going to be minor. So we can go through it. Again, it could fail. It could always fail, but that's giving us lower odds of that trend line holding up. So add all things into account there. And you can usually, that can usually keep you out of, a bad situation. Another one, again, just to go back to crude really quick. Same example. Down sloping trend line, right? Lower high, lower lows, lower low, lower high. Oh, what happened here? Higher low. And so was able to push through that. So again, put all that stuff together and you generally can do pretty good. Again, always stack factors. All right. Couple things I'll throw in here as extras. So I'm going to call these party fouls. Things that I think are Bush League. Again, no disrespect to anyone. There's a lot of guys who make a really good living as traders, and they can do what they do. Certain things I don't like. Asymmetrical crap. So let's look at this one. So use SPX. Hold on, let me use a monthly so it's not messed up. I've seen this trend line out there, a bunch of times. So this is in 2000, and you're connecting that a 21-year line. the market didn't even respect this. I mean, like, you kind of like stalled out a little bit, and you know, we made a higher high, and then we did pull back, but I mean, it did not last very long. Um, it's just there's got to be some symmetry. Again, it doesn't mean it has to be perfect, but I don't like that stuff. I don't like when it's like one hit here, one here, and then like forever later you're connecting that. Another one that's actually going around right now, I think I have it drawn on here. Yeah, is this one, like the NDX. I mean, again, you're connecting something that's 20 years apart, and look at how it's not respecting at all. I mean, did it slow it down? Maybe that's what slowed it down here. The speed of we were melting up, and we kind of slowed down and had a correction. But look at how long our correction lasted, like 5 days. That was it. So I don't love that. I know a lot of people use it. For me, it's when I see it, to me, it's a reach. It's people grasping for straws. Like, I'm down on my position, I'm questioning things, and I'm looking for anything that I can find to justify, still holding. So I don't like those. Another little example, came up with a couple here. This one's actually in my course, the Essentials course, which is on sale right now. But yeah, here. So, and you have some lines here. I'm just going to go to weekly. These lines start out as valid, right? Decent. This one, good distance. We could call that a kiss. But then it, like, your 2011 to 2015, it's just not really. This is symmetrical. The third hit works, and there's a fourth hit, which we know can fail. But you got like a 1 week bounce here, and then it got absolutely roasted and never came back. Right here, 1, 2. If you had come down here and hit it, oh yeah, absolutely. But look what happened when we came down here. I mean, we kind of pierced it. We traded around. I mean, yeah, it bounced. But even after the bounce, it's not like price was really respecting it. Look how much it traded through it. And you could also argue the only reason it even bounced here is because you came into these pivots and you were epically oversold. So again, it doesn't mean, maybe the trend line did have something to do with it, but it's just not, I don't love that. I don't like looking at that. I just don't think it's very reliable. Another one here is BAC, like 1, 2 within 6 months, and then years later, and it just doesn't respect it at all. Again, it doesn't mean it can't work, but you need to stack factor. Like if you have that trend line, and just say, for example, you have that trend line, or a trend line that's that asymmetrical, and you have like a 618, and you have horizontal support, and you got the 200 moving average. Well, then okay, like yeah, but you have a bunch of other factors, so you need to like stack that up for that to be relevant. And even then, like the other factors are more important anyway. Here's the one exception. It has worked before, right? Like it has worked. If the market respects it, like I said earlier, that's why that's the most important rule. If it is working, then use it. Like I don't care if there's 100 years between the trend lines. If the market shows you that it's respecting it, oh, okay, then you use it. But I wouldn't rely on it. I don't. It's got to prove to me that it's going to care. So I don't like the asymmetry. Other things I think are a reach. Made up lines, trends, pivots. Like this one's even more of a face palm for me. I definitely saw this a few times years ago. There we go. So this is valid, right? Hit. You can all agree that. But come on, like, dude, that's not a rising wedge because you don't have a third hit. If you had a third hit here, then yeah, you could make the case. But hey, that also asymmetrical. But you can't just draw it somewhere where there's no, like, oh wait, if it did this, then went up there. Yeah, that's a rising wedge, but it didn't. That's like, to me, that's like made up. Yeah, it's like a reach. Another one that's in the same, um, the same idea is like, oh my god, this one I absolutely hate. When you draw a trend line from a gap, like, oh my god. So this is the worst one. So lower trend line, right? Makes sense. You're drawing it from this gap. No, it has to be from a pivot, right? It can't just be from a made up place. Yeah, I mean, technically, like, it kind of connects through, but look at how easily that breaks bowl and goes to all-time highs. You can't draw it from a gap. Like, that's not very good. Going back to 2023 here too, like, I'm just going to use, whoops. Let's pretend, right? We're not, going, yeah, just pretend that that line makes sense. Like, oh, it's a rising wedge. No, it's not. It's not. Like, you have to, if you wanted to draw it from here, then I could see, and even then it kind of failed anyway. But dude, don't draw it from a gap. Please don't do that. It's got to be from a pivot where price goes up or down, and stops and then goes the other way. That's like beyond Bush League. So those are going to fail. I don't think I've ever seen one of those actually work, but unless it was incidental. All right. Anyway, lastly, another one. Beware of upsloping trend lines in uptrends, and vice versa. Again, same example right here. I don't rely on the upsloping trend line when price is in an uptrend. You can even see like this on Goldman here. Goldman's given us a good examples today. It does work, but then the symmetry gets off and it goes through it. IWM, it kind of works, but then it just goes through it. I don't love them. It's not to say they can't work, but a lot of the time they don't. The exception would be if it's a rising wedge. So I don't have an example off the top of my head for a rising wedge, but I'm sure you guys know what it is. But when it's that, or a falling wedge, same thing, falling wedge. Or if it's in a channel. So again, use that Hughes example. You're in a clear channel, so that top side does work. But even so, I mean, you're not getting much yield out of what are these, like 3-5% corrections? They're not really big levels. I guess they're tradable, but not the best. So I don't really love them. Okay, actually, here's a good one. Use SPX. I'm going to use falling wedge, but yeah, so this would be reliable because it's in a falling wedge. You know it's going to break bull eventually, right? So that would be valid. But when it's just on its own doing that, I generally won't even bother with it, especially in an uptrend. A downtrend, especially if it's a quality stock, eventually you're going to get a bid. That's a whole nother can of worms I don't want to get into about how to pick those, but usually pretty good at that too. But again, upsloping trend lines and uptrends, don't love them. Unless it's, again, like here, another example, spiders. Yeah, technically this held as resistance, but if you went short here, you got blown out every time. And there's no real, it's not a rising wedge. So going short here didn't really yield much. Again, it's not to say that it can't work. Again, I always say that anything can work, but the odds are lower, right? So anyway, one last thing too, just like anything else, don't fall in love with trend lines either. A lot of people, especially certain patterns, wedges, trend lines, head and shoulders, a lot of people fall in love with them because they're very easy to see. They're very aesthetic and pleasing to look at. It's very clean and clear, but there's been plenty of examples where I can show you where a trend line, maybe peaked. In fact, oil, right? we were just talking about this one here where we inched above that and it failed. Or even, this is an example I used a while ago. But if we go back to 2000, that bear market, yeah, you can see right here, I still got them in there. Look at this. From the all-time high, we broke out of it for what, 2 weeks? And then we rolled over here and we lost another 1350 to 950. Another trend line right here. Hit, broke out, and rolled over again, all the way down 775. So again, don't fall in love with it. And that's for every chart pattern too. You know, just because something breaks out doesn't mean it can't put in a lower high. Same thing with on the way up. Just because it breaks out, or excuse me, on the way down. Just because something breaks down doesn't mean it can't squeeze. So again, don't fall in love with them. Don't fall in love with any pattern. It's all about probabilities and putting that all the pieces of the puzzle together. But again, I covered a lot of stuff there. So again, just wanted to do that video. Hopefully that helped out everybody. Let me know in the comments what you guys think. Do you draw trend lines differently? Do you like my rules? Do you hate my rules? Am I an idiot? That's fine. Just wanted to throw that out there. I see a lot of questions about trend lines and people drawing them differently. So I always like to see those different opinions because it is art. Again, it's not like fibs. It's not like an inside bar where you have a low and a high that you can mathematically define. So, and that's what makes a market. So anyways, guys, we're going to wrap it up here. You guys have a great rest of your holiday weekend, and I will see you guys all on Tuesday. Take care.